Good morning. Happy Friday, June 19th, 2020. This is Dan Russo, Chief Market Strategist at Chaikin Analytics. Find me on Twitter at Dan Russo _CMT, bringing you another installment of Stock Market Today, where we're going to look at some of the key metrics about risk appetite in the marketplace. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where we get a lot of the content for this show, as well as give you daily stock ideas to consider that hits your inbox every trading day before the market opens. U.S. equities were mixed on Thursday. Staples and energy outperformed while REITs and industrials lagged. Treasuries were stronger at the long end of the curve. The dollar was stronger against the euro and sterling, but weaker against the yen. Gold finished down 30 basis points. WTI crude settled up 2.3%. Weekly unemployment claims remain elevated as this week more than 1.5 million Americans filed for unemployment benefits for the first time. But as we get to the desk this morning, futures are up 90 basis points to kick off the last trading day of the week. Quadruple options or quadruple expiration day as well. Markets on track for weekly gains despite increasing COVID-19 case counts in some states in the U.S. Trade back in focus this morning with China making commentary about purchasing ag products from the U.S. Asian markets were mostly higher overnight with China up nearly 1%. All of the major benchmarks advanced for the week in Asia. European markets are stronger. Treasuries are weaker with the curve is steepening. The dollar weaker on the yen and euro crosses. Gold is up 40 basis points. WTI crude is up 3%. Taking a look at the structure here of the market, still stalling at the gap is what I would call it. Really not a lot to say that's different other than we have this gap to contend with between, call it 3150 to 3200. Support 3,000 to 3,100 remains the near-term level to watch. Below that, 2,850 to 2,950 to keep the structure of the uptrend off the March 23rd lows in place. Should that remain the case, i.e., if bullet point 2 is true, then February highs are in play. That's the way I see it. That's the roadmap. If bullet point 2 here is false, we'll start to map out downside scenarios. In the near term, we're near oversold conditions. Chaikin money flow is bullish. So for me here, I think it's stay the course, right? Continue to play for upside, continue to identify the strongest areas of the market and the strongest stocks within those areas of the market. The Fed has your back for now, seemingly across asset classes, as now extends to corporate bonds. And you can think of that what you will, but it is, right? And that's what we focus on here. We don't focus on what we think. We don't focus on what we hope. We focus on what is. And what is right now is the market is in an uptrend off the March 23rd lows. It is above the key support levels that keep the structure of that uptrend in place. And it is backed by the printing power of the Federal Reserve. Taking a look at our market in a minute now. What are we writing about in the note today? Well, we ended mixed, a little changed on the day. China, U.S. trade back in focus. We hit on that. Risk appetite is stable this week, and we go through a lot of that in the note, the key themes and relationships that we look at. Software is a key group as growth leads the market higher. That remains our prevailing view. Number 1 on growth, number 2 on software. And as I said, futures do point to a higher open here on quadruple expiration Friday. Taking a look at the major indices now, it really was a mixed, narrow bag yesterday. The Dow down 14 basis points, 3 to 8 bulls to bears on the ratio. S&P 500 up 5 basis points, still a bearish ratio there, 93 to 111. NASDAQ outperformer, because that's what growth does lately. Up 27 basis points, 34 to 12. Small caps flat, an underperformer slightly. 561 to 263 bulls to bears there. Bonds uptick, sending yields lower. Energy up 1.23%, still 0 bullish stocks, 17 bearish stocks for the energy complex. Speaking of software, speaking of growth, speaking of wanting to be levered to that theme, our stock of the day today is Citrix Systems. CTXS closed at 146.73 yesterday, up 94 basis points. Very bullish stock, strong trend above this rising long-term trend line. Strong industry group, software, I heart software. But what intrigues me about Citrix is the potential for a reassertion of relative leadership. Bullish stock beginning to outperform again. It's slight. I may be a little premature here. I'm willing to make the play because the group is strong, and I think we're going to see the rotation back to growth. I don't think we're seeing it. We're seeing it. And I like the spike here in money flow, indicating that the stock is under accumulation. This looks like a consolidation within the context of an uptrend, with the odds favoring an upside resolution. I think if you're looking for a bullish idea, you could look at Citrix Systems, CTXS. Featured in my note today, featured here on this show. Let's take a look at the sector tracker now. Movement of the major sectors over the last 5 days. What I see is tech at the top of the list, and that is encouraging. Materials, financials, industrials, a little bit of a rebound here. Comms and real estate and energy, middle of the road. Discretionary staples, healthcare, and Utes, bottom of the list. All groups now higher. So we went from all red to all green. That's pretty impressive. A lot of the red was, the simple fact of the matter is last Thursday dropped out, right? This is over the last 5 days of trading. So the 6% hit that the market took last Thursday drops out of this equation, which is fine. That's how look-back periods function. Taking a look at our industry in focus now, regional bank services. And this is one where I think if you think that the rotation trade is real, if you think that rates are going higher, you're going to want to see the regional banks outperforming. And I hate to burst your bubble. It's just not the case. Over the past 6 months, the regional bank subsector, KRE, the ticker symbol on the ETF, has underperformed the S&P 500 by 27.9%. Our ratio of bullish to bearish stocks, power bar ratio, is still bearish here, 16 bulls to 32 bears. So 2-to-1 in favor of the bears. So that's weak. It's currently ranked number 19 of 21 subsectors, having moved up 1 slot over the past week. So some of the names there that we want to avoid, or maybe even look for bearish opportunities if you trade to that side of the book. Community Bank Systems, CBU, Independent Bank Corp, INDB, and Southside Bank Shares, SBSI. Names to avoid. Very bearish, very bearish, very bearish. And take a look at the fund here. This looks like a counter trend rally within the context of a downtrend. Bearish ETF, 2-to-1 bears to bulls on the ratio. Trend is strong because we're above the trend line, but the trend line is still declining. Persistently bearish money flow, indicating that the group is under distribution as it continues to underperform the market as it has done since January. And what's interesting here is we tried to dampen the relative weakness, and it looks to me like it's beginning to reassert itself. So if you are in the rotation trade camp, if you are in the camp of rates are going higher, this beginning to move down again works against your cause. Now, it's only one data point. You have to connect the dots, build the mosaic, but it is an important data point given how interest rate sensitive these regional bank stocks are. Taking a look now at what's trending, yesterday's S&P 500 movers and shakers, our gainers and losers. Viacom, some sell-side comments take Viacom up 5.15%. Energy names, HollyFrontier and PSX, both higher to the tune of about, 4.5%, 5% respectively. Dish closed an M&A transaction. That sent that stock higher by 4.5%. And Oracle reported earnings on Wednesday night. Stock higher by 4.2% yesterday. And it catches a downgrade here today. So watch bullish rated Oracle here following a sell-side downgrade. On the loser side of the board, not a ton of news, really. Biogen, BIIB, down 7.5% on the back of a court ruling. Ross Stores, ROST, a bearish stock, down 4.5%. Didn't see anything company-specific there. ADS, same story. Didn't see anything company-specific to send that stock higher down, lower rather, 3.5%. NVR, 3.5%. LKQ, 3.5%. No real news there. We're kind of in a news vacuum, if you will, at the stock level, right? We're getting, kind of towards the end of June, right? So we're getting close to the end of the second quarter. not quite in earnings season yet. So very much a macro-driven market for the time being, in the absence of company-specific news. So that's why you're seeing reactions to some of the economic data, reactions to the trade data that was discussed this morning, or the trade commentary. It's more of a macro market right now. We will get back to a micro market sometime back in July once we start getting second quarter earnings reports, which I think will be interesting because we're going to want to see what kind of visibility companies have into their businesses for the back half of the year. But company-specific news, not a lot to go on. Focus on price. Let's take a look at the key risk themes now, or at least a couple of them. One that I like to focus on is high-yield bonds against treasuries, right? If investors are risk-seeking, high-yield bonds should be outperforming treasuries. If investors are risk-averse, high-yield bonds should be underperforming treasuries, as has been the case since October 2018. This is a weekly chart of HYG to IEF. There's the top. That's October, November 2018. There are some who will make the case that the equity market was in a bearish market, or a bear market that started in January 2018. And if you look at areas like small caps or the value line geometric index, right, you can make that case. So there are some making the case that the bear market ended in March and did not begin in February. I just want to be on the right side of the trend, right? You know, for the better part of 15 months now, we've not liked small caps. So if small caps are in a bear market, great. They've underperformed and we were on the right side of it. So I hate labels. I just want to be on the right side of the trend, and I want to be on the right side of what's outperforming. So high yield versus treasuries, trying to rebound here, but still a lot of work to do as it trades below the 200-day moving average, or 40-week moving average in this case, which is declining. Rally has not been able to get the 14-period RSI, and remember, this is weekly data, out of bearish ranges. So the weight of the evidence still supports down from here, but we'll see, right? Could very, very easily change itself. We'll take a look at that. And that's all playing out as Treasury yields, the bottom of the chart, are trying to bottom, but not exactly screaming higher. So kind of an interesting dynamic here if we look at high yield relative to treasuries. What about growth versus value? This is probably my biggest thought right now, is that growth is going to continue to lead, right? Nice steady uptrend. Looking at, U.S. growth against U.S. value. Nice steady uptrend above a rising 200-day moving average. Well, notice the RSI, right? Here was the trade that everybody got excited about and said, now we're going to see the shift back to value, right? RSI never even became oversold. And now it's moving back into bullish ranges. Look at the Qs breaking out relative to the SPY. That's growth, folks. That's growth outperformance. There's no two ways about it. It's growth outperformance with momentum behind it, right? So that's kind of interesting as well. The ratio of growth to value is back up near the highs, right? So I personally think that growth is going to continue to outperform. I think that there will come a time where value outperforms, but I don't think we're there yet. And obviously when the facts change, I'll change my mind. But right now, to me, the facts have not changed. And then finally, I said I like software, right? If I think about growth, I certainly think about tech and I think about software. Mark Andreessen made this quote famous: software is eating the world. And we got software trading up near new all-time highs, XSW, the software ETF here, software and services really. Take a look at the CCI here, middle of the range. So not overbought, not oversold, kind of an interesting area during this consolidation for a group that is continuing to massively outperform the broader market. So I have the market holding support. I've identified a strong group, software. I've identified a nice name within that group, Citrix. That's the process in a nutshell, folks. I hope you all have a great weekend. Take some time, head over to chaikinanalytics.com/test drive to sign up. Free 14-day trial. Get my note every day for the next 2 weeks. Follow my thought process. Mark Chaikin's notes on Sunday. Hope to see you on one of our open forum sessions soon. Have a great weekend, everyone.